Hello options traders, and welcome back everyone. Well, I thought this might be a really good time to talk about a little bit more of an advanced topic for some of our more advanced traders in the group. And the reason I thought this might be helpful is I've been hearing a lot of traders talking about using trades like calendar spreads and diagonal spreads because of all of the recent volatility. And in most cases, those can be pretty good choices, but you have to be aware of something called Vomma. So what is Vomma and why does it matter? Well, before we get started, as always, please remember to click like. It does go a long way in promoting the channel, and it's definitely very much appreciated. So to understand Vomma, we have to first start with Vega. Vega is one of our 5 main Greeks, and what Vega shows is an option's sensitivity to changes in volatility. So for example, let's say that you have a $100 call trading for 3. And let's say that that's priced at $3 with a volatility of 20%. You look at your broker's platform and you see that it has a Vega of 0.10. What this means is that if volatility rises 1 tick, that is from 20 to 21%, sometimes we'll call it 1 percentage point, but usually professional traders call that 1 tick. What that means is that that $3 option is going to increase by Vega. It's going to pick up 10 cents. So we would expect that $100 call to be trading for $3.10. And this is very easy to check on a pricing model. Just put those numbers in, look at your Vega, increase volatility by 1 tick, and you will see that the numbers come out. So it's just a way of working the pricing model backwards. But Vega is important to understand because it allows you to see the effect of volatility. And if you get caught into one of these really rapidly rising, accelerating volatility periods, such as during COVID, or even recently in April and May of 2022, it can backfire. Yes, it can help you, but it can also backfire, and this is why you have to understand it. So when it comes to Vega, which options have the largest Vega? Well, longer dated options have the largest Vega. This is assuming all else being equal. So if you have a 30-day option, it's going to have a certain Vega, but if you have a 1-year option, all else being equal, that 1-year option is going to have a much larger Vega number. However, the shorter dated options have the greatest acceleration of Vega. And this is another Greek. Sometimes it's called a second tier Greek. Second tier meaning that they're not usually the primary ones, kind of a second category of Greeks, and it's called Vomma. And what Vomma does, it shows how sensitive your Vega is to changes in volatility. Remember that Vega showed how sensitive your option's price is. Well, Vomma is doing the same thing, but it's just relating it to Vega. So take a look. Now I'm going to use out of the money options because if we keep the strike and the price the same, in other words, an at the money option, changes in volatility aren't going to change Vega all that much. So this really pertains to either in the money or out of the money options. But let's say that we have a stock of 100 and a strike at 95 and volatility is 20%. Now I'm going to use the puts. It applies equally well to the calls, but in periods like this we usually get a lot of traders who like to sell out of the money puts thinking, hey, I'm getting this nice big volatility. I can get this nice big premium for selling this put, and if I get assigned, I'm just buying stock at a discount. So again, it becomes a popular strategy during high volatility periods. I'm not saying it's a good one, I'm just saying it's one that a lot of traders use. And what I'm trying to show you is another aspect that you have to be careful of. So for this put, it tells us that our Vega here is 0.0747. So what we're going to do now is to increase this by 5 ticks. We're going to take it up to a volatility of 25%, all else being equal, and the Vega has now increased to 0.0876. That's an increase of 17.3%. So a fairly small bump in volatility causes the puts Vega to accelerate very rapidly. Well, very rapidly compared to what? Well, let's go and do the same thing for a 1-year option. So now I've reset my volatility to 20%. I've increased the time from 30 days to 360. And yes, now we can see the Vega is 0.3728, much bigger than it was before for the 30-day option. But what about the acceleration? That's what Vomma is going to show us. So take a look. If I now increase volatility by 5 ticks from 20 to 25, 0.3731, it increased by 0.08%. That's 8/100ths of 1%. It barely budged. So this is why you have to be careful when you hear traders saying, oh, the longer dated options have the highest vega. That's true. They have the biggest number for vega, but they don't accelerate all that much. And depending on the strategy, you have to be aware of that and be careful because, again, it can backfire. So I just did an example moving the volatility from 20 to 25%. Here's a table that shows various volatility changes. So as before, I'm going to use the stock at 100 and the $95 put. Here's 20% volatility for the 30-day option. Here's the 30-day vega. That's what we saw, 0.0747. If I increase it to 22%, it bumps up to 0.0818, or an increase of 9.5%. You go to 24%, it's going to increase 12.6. That's going from 0.0747 to 0.0841. I'm always comparing it to this 20% level. It's an increase of 12.6%. If we bump it up to 30%, it increases by nearly 25%. And if we double it, going from 20% to 40%, it increases about 35%. Again, this is the options vega. But look what happens if we do that same exercise with a 360-day option. So as we saw before, the vega is 0.3728. This is the $95 put with 360 days to expiration. But if I increase volatility to 22%, it actually decreases vega by a little bit, down 0.11%. If we go up to 24%, it goes to 0.372, again down 0.21%. It's a decrease. That's going from 0.3728 to 0.372. If we increase to 26%, we finally get an increase to 0.379. That's an increase of about 1.66%. Again, that's comparing it to this starting value of 0.3728. But notice if we increase from 20% volatility all the way up to 40%, we double it, you just increase by 0.48%. It's about 0.5%. You've gone from 0.3728 to 0.3746. Hardly anything noticeable at all. So the thing to understand about Vomma, you must be careful when using diagonal or calendar spreads. And again, that's because you are buying the long-dated option and you will sell the short-dated option. And the short-dated options accelerate your vega much faster. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Options A to Z Facebook trading group, and you can find a link in the description below.